Ever wondered why a chunk of your paycheck disappears before it even reaches your pocket? That's income tax, my friends. Income tax, it's a term we all know, and let's face it, one that might make us cringe a little. But what exactly is it and why do we pay it? Well, income tax is a financial charge imposed by the government on your income. Essentially, it's the price we pay for living in a society. These taxes are used to fund public services, infrastructure, and other governmental operations. And they are not optional. But don't worry, it's not as grim as it sounds. Let's break it down a bit. The general principle of income tax is simple. The more you earn, the more you pay. It's a progressive system designed to distribute the tax burden fairly across different income levels. This means that individuals with higher incomes pay higher rates of tax, and those with lower incomes pay less. You might think income tax is just about wages, but it's more diverse than that. The taxman doesn't discriminate. Many forms of income can be taxed. Let's say you're a savvier saver and have some interest piling up in your bank account. Or perhaps you're a budding entrepreneur raking in dividends from your successful venture. Maybe you're a property mogul, collecting rental income from your vast real estate empire. Well, all of these are considered taxable income. It's also worth noting that not all income is taxed equally. Different types of income can be subject to different tax rates. For instance, long-term capital gains, which come from selling assets like stocks or property, are often taxed at a lower rate than regular income. It's a complex system, but understanding it can help you make smarter financial decisions. So now you know what income tax is, but how exactly does it affect you? Let's delve deeper. Alright, so you earn money and some of it gets taxed. But how is this amount determined? Well, let's dive right into it. In the United States, we have what's known as a progressive tax system. This means that the more you earn, the higher the percentage of your income you're expected to pay in taxes. But it's not as straightforward as it sounds. You see, your income is divided into portions or brackets, and each bracket is taxed at a different rate. Imagine you're climbing a ladder. The first few rungs or income brackets are taxed at a lower rate. As you climb higher, the tax rate increases. However, and this is crucial, only the income in each bracket is taxed at that bracket's rate. So, if you move up a rung, only the income that falls in that new bracket is taxed at the higher rate. The rest of your income, the part that falls in the lower brackets, is still taxed at the lower rates. Clever, right? But wait, there's more. The amount you owe in taxes isn't just based on your income and tax rates, it's also influenced by tax deductions and credits. A tax deduction is an expense that you can subtract from your taxable income. Think of things like student loan interest or contributions to a retirement account. These deductions lower your overall taxable income, meaning you pay less in taxes. On the other hand, a tax credit directly reduces the amount of tax you owe. It's like a gift card for your taxes. For instance, if you qualify for a $1,000 tax credit, that's $1,000 less that you have to pay the government. So that's the basics of how income tax works. It's a combination of tax brackets, deductions, and credits. It might sound complicated, but once you understand the system, it becomes much easier to navigate. Understanding how income tax works can help you make smarter financial decisions. But what about those tips you earn or give? Let's find out in the next scene. You've worked a long shift and your tips are the sweet reward for your hard work. But did you know even those are taxable? Quite surprising, isn't it? But let's delve deeper to understand this better. In the eyes of the Internal Revenue Service, or the IRS, tips are considered as income. Yes, you heard it right. The cash you receive at the end of the night, or even the additional amount on a credit card slip, are all part of your earnings. This means they are subject to income tax. Now you might be wondering how this works in practice. As an employee, you are required to report any tips you make that exceed $20 in a given month. This includes cash tips, of course, but also items of value, like event tickets or other gifts received as tips. Your employer also has a role to play in this. They need to keep track of the tips you report and include it in the W-2 form they provide you at the end of the year. This form is crucial because it's what you use to file your taxes. But what if your employer doesn't do this? Well, it's still your responsibility to report your tips. If you fail to do so, you might face some heavy penalties. So it's always better to keep a detailed record of your tips, just in case. Now, before you start to panic, let's talk about some good news. While tips are taxable, there are ways to manage your tax liability. For example, if you have business expenses related to your job, like uniforms or transportation costs, you may be able to deduct these from your taxable income. In conclusion, tips aren't just free money that you pocket at the end of the night. They're part of your taxable income, and you have certain responsibilities when it comes to reporting them. But remember, there are also ways to manage your tax liability. Yes, unfortunately, tips aren't just free money, they're part of your taxable income. But don't worry, there are ways to manage your tax liability. So taxes are a necessary evil, but with some clever planning, you can ensure you're not paying more than you need to. Let's dive right in. First up, deductions and credits. These are your best friends in tax planning. Deductions reduce your taxable income, while credits subtract directly from your tax bill. So, don't shy away from keeping track of potential deductions throughout the year. These could be anything from mortgage interest, to medical expenses, to charitable donations. And always look out for credits you may be eligible for, like the child tax credit or the earned income tax credit. Next, tax-advantaged accounts. These come in various forms, from retirement accounts like 401(k)s and IRAs, to health savings accounts. These accounts offer either tax-free growth or tax-free withdrawals, making them a valuable tool in your tax planning arsenal. But don't forget about the timing of your income and expenses. If you expect to be in a lower tax bracket next year, it might make sense to delay some of your income to next year if possible. Similarly, if you expect to be in a higher tax bracket next year, you might want to accelerate your deductible expenses into this year. Another good strategy is to diversify your investment portfolio. Different investments are taxed at different rates. For example, long-term capital gains are usually taxed at a lower rate than ordinary income, so having a mix of investment types can help to manage your overall tax burden. And lastly, consider seeking professional help. Tax laws can be complex and are constantly changing. A tax advisor can help you navigate these complexities and ensure you're making the most of your tax planning strategies. Remember, the goal is not to avoid taxes altogether. That's illegal and can lead to serious consequences. The goal is to understand the tax laws and use them to your advantage to ensure you're not paying more than necessary. Remember, it's not about evading taxes, it's about understanding the rules and playing the game smartly. So, we've covered a lot today, let's quickly recap. We embarked on this journey by introducing you to the world of income taxes. We shed light on why these taxes are necessary, how they fund public services, and why it's important for us all to contribute. After all, taxes are the lifeblood of our society, driving the engine of public welfare and infrastructure development. Next, we dived into the mechanics of how income tax actually works. We explored the concept of tax brackets, showing you how the amount you earn dictates the rate at which you're taxed. We also touched on the difference between gross and net income, a key distinction when it comes to understanding your tax obligations. From there, we dove into the often overlooked area of tipping and taxes. We discussed how tips, whether received directly or through a service charge, are considered taxable income. Whether you're a server, a bartender, or a taxi driver, those tips you receive aren't just extra cash in your pocket. They're part of your income, and Uncle Sam wants his share. Then we moved on to the crucial topic of tax planning strategies. We highlighted the importance of planning ahead, of taking advantage of tax deductions and credits, and of making informed decisions that can help reduce your overall tax burden. We talked about how keeping good records, contributing to retirement plans, and even considering the timing of certain financial moves can all play a part in managing your taxes effectively. And now, here we are. We've navigated the complex world of income taxes and tips, and armed you with the knowledge to understand and manage them better. This knowledge isn't just power, it's potential savings, it's financial security, it's peace of mind. Remember, understanding your taxes is an essential part of financial literacy. So keep learning, keep growing, and keep your money where it belongs, in your pocket.